Have you ever watched a stock or crypto just sit there, consolidating, going nowhere, and then bam, it explodes either up or down and you missed it? Well, what if I told you there's a way to spot these explosive moves before they happen? Today at Broker Check, we're breaking down the 3 triangle patterns that professional traders use to catch these breakouts early. And trust me, once you understand these patterns, you'll start seeing them everywhere. Before we jump into the specific patterns, let's talk about what triangle patterns actually are. Simply put, triangle patterns are chart formations where price action moves within 2 converging trend lines. This shows the competition between buyers and sellers is becoming intense. You've got your support line here, your resistance line here, and as these lines get closer together, price bounces between them with less and less room to move. Now, here's what makes triangles so powerful. First, you've got clearly defined support and resistance, so you know where the boundaries are. Second, you see either lower highs, higher lows, or both, which tells you the volatility is compressing. And third, and this is crucial, volume typically decreases as the pattern forms. It's like the market is holding its breath before a big move. When that compression releases, that's when you get your breakout. And that's exactly what we're trying to catch. There are 3 triangle patterns. Let's start with the symmetrical triangle, probably the most common of the 3. Here's what it looks like. You've got a series of lower highs and a series of higher lows. Both trend lines are converging toward each other at roughly the same angle. What does this tell us psychologically? Indecision. Bulls and bears are in a tug of war. Neither side is winning, but somebody's about to give up. Now here's the thing about symmetrical triangles. They can break out in either direction. It's not a bullish or bearish pattern on its own. The pattern is basically saying, big move coming, but I'm not telling you which way. Look at this example. See how price kept making lower highs and higher lows? The range got tighter and tighter, and then boom, breakout to the downside with a volume spike. So how do you trade it? First, wait for the breakout. Don't try to predict it. Instead, confirm it. You want to see price close clearly outside one of the trend lines, ideally with strong volume. Second, your entry is typically on the breakout candle's closing price, or better yet, on the retest of the broken trend line as new support or resistance. Third, place your stop loss just inside the triangle, above the last swing high for a bearish break. Big warning here, fake outs happen. Sometimes price will poke through one side, then reverse and blast through the other. That's why volume confirmation is so important. The second pattern is the ascending triangle. This one's different because it's not symmetrical. Instead, you've got a flat horizontal resistance line at the top and a rising support line with higher lows underneath. What's the market telling us here? The buyers are getting more aggressive. Each time price pulls back, buyers step in at higher and higher levels. They're saying, we're not willing to sell that low anymore. Meanwhile, sellers are defending that resistance level at the top. But here's the key. They're getting weaker because buyers keep coming back stronger. This is typically a bullish continuation pattern. If you see this forming in an uptrend, there's a good chance price is about to break through that resistance and keep going higher. Check out this example. See how price kept bouncing higher and higher off that ascending support? Then finally, it broke through that resistance level with conviction. Trading strategy. Either enter at the breakout above resistance, wait for a candle to close clearly above that level, or on the retest. Confirmation is everything. Look for a strong breakout candle, not a tiny little poke above. Check for a volume spike. This shows real buying pressure. Bonus points if you see a bullish engulfing candle or similar confirmation pattern. Set your stop loss right below that ascending support line. Now, before we move to the third pattern, I want to emphasize something crucial. Having a good broker matters. You can have the best trading strategy in the world, master every triangle pattern, but if your broker is ripping you off through hidden fees, manipulating trades, or using shady practices, all your hard work goes down the drain. That's exactly why we created Broker Check. Our team has spent countless hours researching and comparing multiple brokers so you don't have to. Visit the link in the description below to find detailed broker comparisons, read honest reviews, and choose the one that actually suits your trading style and protects your money. Because at the end of the day, your broker should be your partner, not your enemy. All right, let's get back to patterns. Time for the third one. The third pattern is the descending triangle, basically the twin of the ascending triangle. Here's the setup. You've got a flat horizontal support level at the bottom and a descending resistance line making lower highs above it. This tells us sellers are in control. Each time price rallies, they knock it back down at lower and lower levels. Meanwhile, buyers are trying to defend that support level at the bottom, but they're getting exhausted. This is usually a bearish continuation pattern. If you see this in a downtrend, odds are good that support is about to break and price will drop further. Look at this example. Price kept making lower highs as sellers pressed harder and harder. That support held for a while, but then breakdown. Now, how do you trade this without getting wrecked? Wait for price to break below that support level and close beneath it. No close, no trade. Or better, wait for the retest. Place your stop loss just above that descending resistance line. If price breaks back up into the triangle, the pattern has failed. Here are some common mistakes you should avoid. Shorting too early. Just because you see a descending triangle doesn't mean support will break. Sometimes price actually breaks up from these patterns. It's less common, but it happens. That's why we wait for confirmation. Another mistake is ignoring the bigger picture. If this descending triangle is forming at major support on the weekly chart, maybe think twice before shorting. There you have it. We've covered the basics of all three triangle patterns. Now, there are some special scenarios that, if traded properly, can be wildly profitable. If you want us to dive deeper into those advanced setups, let us know in the comments below. Creating these detailed breakdowns takes a lot of time and research. So if this video helped clarify triangle patterns for you, do us a favor and hit that like button. It really keeps us motivated to create more content like this. And don't forget to subscribe and press the bell icon so you never miss out when we drop new videos.